All right, Justin, thank you for the introduction there. So let's get on going. My name is Daryl Martin. I'm a trader. I trade every day, and I'm at ApexInvesting.com, and we have live trade rooms, all that fun stuff, and we're always placing trades in there. And what I wanted you to, we always start off putting up the simple disclosures. Obviously, investing has risk, and make sure you know what you're doing before you do it. That's a simple summary for you. And let's see, just second disclosure, put that up there, knock that out, get that out of the way. All right, so on the 10 steps, it's sort of the 10 steps I use, the 10 rules I use in trading. And a lot of people go, what's professional traders? And professional traders, of course, are those people who trade full time for a living. What is their secret? And the big secret of a professional trader is they see the market differently. Whereas sometimes we come in as new traders and we try to see the market as, all right, when this crosses that, then what I'm going to do is I'm going to buy this and then sell at hit this point, and I'm thinking about risk reward and all that stuff. They're still, obviously thinking about risk reward. They're obviously still thinking about probability, but they're thinking about it in a whole different way. They're thinking about it as supplier versus consumer mentality, meaning where are people going to place their orders? So if there's a stack of orders at a certain level, such as where a whole bunch of traders might be looking at Fibonacci levels, support resistance, pivot points, 200 period moving average, when they see all those things coming together, that's when they know there's going to be what's called confluence, and there's a lot of orders. And so what they want to do is they want to drive the market to that place and then get rid of their orders. Okay? And so right where you're thinking about getting into a trade, whether you're thinking about getting, buying, on a breakout of that, resistance level, or whether you're thinking about, selling because it's gonna, you think it's gonna bounce off the fib level, they don't really care. What they're thinking about is, I want to be getting out of my position at that point. And that's why a lot of times as traders, what happens is we get in this trap of always seeming to, no matter when I get in, I buy, the market goes the other way, and because we're not thinking about it as everybody else is doing the same thing right here. Most of the retail traders are all piling up in the same spot, which is important if you may think about it. If you're handling, whether it be, 1 million shares of stock, or you have, 100 futures contracts, or, 20 or 30 full lots on FX, you need to know where orders are going to be at just so you can get out of the market without having to, basically hurt yourself by moving the market against you. So another thing is they filter out the noise. I'm sure you've all heard of floor trader pivot points. And what they would do is they'd go in and they weren't concerned so much with the chart and what happened on this 10-minute bar and that 10-minute bar and this 5-minute bar. They were at these certain points, is where they're looking to, start doing certain types of trades, scalping trades or whatever that they're doing down on the floor. And the third thing is they have proper expectations of market movement. Most people that I know, most traders that I've talked to, have no actual expectation of market movement. They have a desire, when you buy, you want it to go to the moon, or they want to make 2 to 1, or, whatever, but they actually have no expectation of how far the market should move on any given day. But a professional trader knows what the expectation of movement is. And so I'll also talk about that. How could you actually know how far the market expects the market to move? And I'm not talking about pivot levels even. This is actually going a little step deeper. So we'll talk about that, because if you don't know how far to expect the market to move, what if the expectation, the 70% expected move, is where you get a buy signal? Well, the probability is that only 3 out of 10 days would actually keep going past that point. Okay? And so you're buying basically at the high over and over and over again. And you really shouldn't expect to make that much on this trade, because even if it does break it, it's probably not going to go too much further. So you want to have that proper expectation of market movement. I'll show you how to do that very easily. Okay, and just for some people that may be new at trading, some that been around a while, trading is not as easy as you want it to be, but it's not near as hard as most people think it is. Most people make it really, really hard, but everybody wants it to be really easy. So there's a fine balance in there. You do got to put in a little work, a little effort. It's not all red and green arrows, but it's also not having 45 indicators on top of your chart and trying to figure out how to analyze these patterns backwards, because you can't really ever see them going forward. So it's a good balance there. A big thing you need to do in 2014, if you haven't already been doing it, okay, is you need to use a system for trading. You cannot trade on gut alone. All right, gut has its place. It's a very small place, and I actually call there's system trading and there's style trading. Okay, and system trading is your rules for entry and exit. Style trading is reading the market. And I actually subdivide style trading into two separate pieces. One part of style trading is that gut trade, because you think you're so smart and you can outsmart the market and you can call it, and this is what I think. And which is dangerous, because then you have an opinion, and that doesn't work out as well as we want it to. Now, the other type of style trading is when you go into things that you see consistently. You maybe can't program them, but they're things that you can use over and over and over again. I'll talk about a couple of those. And we use a few style things that are not gut-based. They're things you can see, but we see them over and over and over again. They're not our official rules, but they're things that we just cross-check if all of our rules line up. So a professional trader needs to be very system-based. They need to have exact entry, stopwatch, trailing stops. If you don't know where you're going to get out of the trade or how you're going to manage that trade once you get in, you shouldn't get in. Because what will happen is, and I know, like, once we get in, the adrenaline goes, right? Every single tick. So it ticks against you. Ooh, what am I going to do when it goes against me? Am I going to get out? Am I going to go the other direction? Am I going to get in again if I get stopped out? Am I going to move my stop? All those dangerous things that we go through. And then when it starts going in our direction, we're so happy to see green, it's very easy to take it too fast. Or, we're up, we were risking $100, now we're up $100, I'm just going to take it. Or we're up 200, I'm just going to take it. But then that becomes like a $2,000 move day on oil. And we miss out because we don't have an objective system that is outside of our emotions, outside of our psyche. And one of the things I tell people is, you should not be basing your trailing stops and things like that based on your P&L. Okay? And a lot of our traders, something I try to do, and I know they do, and is we actually hide our profit and loss, which sounds crazy, but as long as you don't risk too much, okay, like you need to know what your risk is. So if I get in at this on this many contracts, and this is my stop, this is what my risk is, as long as that risk is acceptable to you, okay, then you should be okay with not looking at your P&L. Because your P&L, as hard as it is for us to admit, doesn't affect the chart. It doesn't make it go up or down. So the chart makes our P&L go up and down, but our P&L has absolutely zero impact on it. So trying to make a decision on a trade based on P&L is absolutely pointless because it doesn't have anything to do with it. So what you want to do is really base your trades on the charts. And you're going to need that system to be able to trade that kind of confidence because you'll need that system for consistency. Otherwise, it's a different trading system every day. And there's definitely going to be opportunities. You can't have any doubt that opportunities do exist, but you have to understand that the risk is there and have the confidence to execute it. And whatever your system is, it's not built on, it can't be built on some magical indicator. It doesn't exist. The magical indicator in trading is you. It's actually going in and having good risk management, having good profit management, and having your probability as high as possible. That is the magical indicator in trading. Okay? It's not, I got a nice little arrow and therefore this tells me what to do. So that's our system, and we're going to go into building a system. And what do you need to build a system to accomplish this goal? Like as a trader of limiting losses and letting profits run. You need a price action driven method to define the steps in your trading. Okay, indicators are lagging. We've all felt it. All right, profit and loss on your trade is not going to help you. The best thing you can do is price action driven method. And these steps, whatever the steps are that you choose, whether it be this system or some other system in 2014, they have to account not only for how the market moves, but there's another piece that we can easily, if you've been trading for a while, that we can easily leave out, and that's the trader psychology aspect to ensure the rules, that you'll implement them consistently. Such as, I can give you a system right now, okay, that, would profit 9 out of 10 times. Great. The problem is when you win, each time you make $1, when you lose $10, so you're down. On the flip side, I give you a system that would lose 9 out of 10 times. but you'd only lose $1 when you lost, and you'd make $10 when you won. So you'd be net profitable. But could you take it? Could you psychologically take the 9 losses for the 1 win? And what if it ended up being 90 losses in a row and then you got 10 wins in a row? Could you actually psychologically take that? Could your account take the drawdown? Could your stomach take losing again and again and again? And so you need that balance of not only rules that work and make money, but also psychology that will allow you to confidently, consistently execute the system that you're trading. I hope that makes sense. So, it's a piece I think a lot of people leave out whenever they're doing designing their own trading system. All right, so let's get into the Apex Elite trading method, and we'll sort of do a summary here on the 10 rules. One thing is, I'm going to go through this. I don't expect you to master this system in 45 minutes here or so. Obviously, that's unrealistic. What I want to do is I want to show you sort of what I do, how I do it, how it could help you, and if you decide that you want to learn more, then you're going to be able to try it out for free, fully for free, for like an entire month. Live trade room, everything, okay? And so don't expect that you're going to like master everything in the next 30 or 45 minutes. I just want you to go, hey, does this look like something that'd be worth my time? Because that's the main goal here. And I'd love to teach you to in 45 minutes. It just may take you a little longer. Here's an example on the charts, and what we're doing is we're letting our profits run. We're flipping around. We're going the other direction. There's a lot of trades in here that we can do, and these are some of the chart markups. Different charts that we've done recently on different trades, and you'll see bought. We sold right there. We had a small loss, but then we had another profitable trade. We trail. This one was basically break even, profitable, and we have all sorts of trades in here. So I can go through tons of charts for you, different examples. But the main reason here is I just want to show you the oil, gold, currency, Aussie, Russell. So we can go into a lot of different charts, but you can apply this on commodities, futures, indices, Forex. You can apply it on stocks. So I have traders that apply it on binaries and even Nadex spreads. So a lot of different markets you can apply the same strategy on because it's all built on how the market works. I also have a radio show if you ever want to tune into that. I have a radio show on tfnn.com every day from 1 to 2 Eastern Time, and you're welcome to tune in on that. But these are the things we're going to go through. We're talking about bar size, and this is going to be the 10 steps are going to be the 3 filters and the 7 triggers, okay? So what bar size should you be using? What is this one pattern thing? You've been seeing this Apex pattern on the screen. What is it? So out of those 10 steps, what are the 3 filters I use to help me eliminate bad entries? How do I know what my exact entry, stop loss, and position size will be when I do a trade? And then what are the 7 trailing stops that I use to allow my profits to run? And then finally, how do I know how far the markets will move each day? So that way I don't keep adding on to trades right as the market's topping out. Or maybe I just got started and the market has actually already topped out overnight and I don't know it. So how do I do that? And we'll talk about how to do that. It's very easy. The first thing I do is I actually remove time from the equation, which sounds weird, but think about this for a second. Time-based bars are completely illogical. If you have a new 5-minute bar on your chart, does that mean anything? I mean, it may have been, think about how big and small a 5-minute bar can be, right? It could be, 20, 30 ticks. It could be 2 ticks. Okay, so I got a 5-minute bar, 5-minute bar, 5-minute bar, 5-minute bar. If nothing's happened, just time has passed. Well, time passing, a new bar forming on your chart, isn't what moves the market. It has nothing to do with what moves the market. So get rid of time on the chart. And what should you be looking at? You should be looking at price. Time-based bars are really choppy. Like I said, you're looking at 5-minute bars. You can have 12 bars in an hour and nothing has happened at all. And it's completely pointless. And now all your indicators are all jacked up because they're all trying to read the highs or lows or closes or whatever of those bars to write up those indicators. And now all your bars are all, basically all your indicators are messed up. And it's no wonder you can't figure out whether things can go long or short. So remove time from the equation. And what we have is It's similar to a Renko bar, but it's definitely not a Renko bar. Okay? And if you don't know what a Renko bar is, that's fine. Basically, a standard Renko bar is simply a bar where if the market moves, say in this case, 6 ticks, okay, then it will make a new bar. So if the market moves 6 ticks, it'll make a new bar. If it takes 5 hours, you know, like down here you can see we actually are timing it. So there's like 50 minutes. So it took an hour to make that 6-tick bar. Now it also could do it in seconds. So like over here, these little yellow bars are called velocity bars. So it could actually make it in less than a second. So either way, if it moves 6 ticks, it's going to make a new bar. It doesn't matter how long or how short it is. And I mean, imagine like right here, 60 minutes, you would have had all this like mess going on. Right? You'd have had 12 bars right there, and like nothing's happening on that bar. So it gets rid of that and makes your charts very, very smooth. The next thing is we apply a pattern. One thing that I learned when I was actually studying with some market makers, and I've studied with market movers, the boys who say, I'm going to make Microsoft go here, 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 then here, because they have the money to actually do it. And I started noticing a pattern, and they taught me sort of a similar type pattern that they were using, and it basically just had to do with how the market oscillates. And then I started looking at all these other patterns that I've been studying forever, you know, and I had the, you know, the whole big wall of charts of the 45 candlestick patterns and all that stuff. And I started noticing this pattern is inside all of those patterns. And so it actually all narrowed down to one simple pattern. And remember we talked about earlier, the market moves to fill what a professional trader is supply demand, right? Okay? So they're thinking, where is the market going to be at? Where the order is going to be? And they move the market to fill those orders. So this pattern, you know, we've labeled it Apex, so which is actually where the whole ApexInvesting.com comes from. But alert, pivot, entry, and then basically complete X. All right, X marks the spot. And I'll talk about the rules here in a second. But what happens is the market pulls back down, it breaks that, and then it moves on back up. You may have seen these as sort of like a 1, 2, 3 type pattern. This is a little bit more sophisticated, but you know, similar to that. And alert, pivot, entry, X, alert, pivot, entry, X. And I used to use this on, you know, time-based bars, but it required a lot more gut style, you know, trying to read the market. When I put it on the diagnostic bars, it became a lot cleaner and a lot easier for me to see it because I was getting rid of time and I was just focused on price. And you know, I said earlier, the diagnostic bars are sort of like Renko bars. The difference is we actually have highs and lows. Okay, so we represent the true high and true low on the chart. So if it came down, you're going to see that. Okay, you're not just going to see a Renko bar will actually get rid of wicks. You won't see highs or lows on a Renko bar. We also actually have a special code built inside of them where we're tracking not just time, but we're actually tracking speed. So Ninja, like they'll give a plot, you know, every second or whatever. We're actually, or every minute, we're actually drilling down to milliseconds. And we're recording that data as it builds the chart. That's why it may take like, 30 seconds to a minute for your chart to load. What it's doing is, it's actually going back, it's pulling all the data by the millisecond, and it's building the velocity bars, it's building the timer bars. We actually get true volume on our bars. If you pull up a Renko chart, you may actually get, it may move literally like 10 Renko bars in a second. Okay, well if that happens, all your volume is going to be on the last bar. Another thing that we do is we build it from a starting point, so that way you have a consistent chart. Whereas if you've seen modified Renkos and stuff, every time you change, if you load more days, less days, if you change anything, then you get a completely different chart. So we want to make sure we have a consistent chart so we know what we're looking at. And so there's a lot of little things, but part of it's drilling down to milliseconds for time and for speed, and also making sure that the bars know how to reset so they're consistently built. Once we did that, I was like, sweet, this is great. I have very clean charts. I can trust the bars. They're working well. I can apply this pattern that I've been using for years on top of it. And so we got the apex. So basically this is like the market moves up, and that's the highest price. Then we get a lower high. That makes it an A. As soon as we get that lower high, we get an A. And then our lowest point is our pivot. Okay? So we know it's our lowest point once the high of that bar is broken. So basically, we're looking for the bar to be broken, looking for it to be broken, looking for it to be broken. Okay, it's broken. Now that it's broken, that's going to be our pivot. And then we have our E bar. That's basically our entry breakout bar. That's the bar we're looking to get in on if the market continues to rise above that level. And then When we get an X, we can tighten up our stop. So alert pivot entry X, tighten up the stop. Alert pivot entry X, tighten up the stop. And we can literally, there's multiple stops we'll use 7 stops for tightening up. And then it comes up here. This is actually what we'll call a BMX, and I'll touch on it briefly. But it means a barely missed X. So it would have been an AP, and then that's that failed E there, that orange E. Now failed E doesn't mean we got in because it didn't break 3 ticks above the high, but this is actually a reversal signal. It actually told us to go short. And then we got additional shorts all the way down. So as you can see, the charts are very clean. I'm not going to say they're always this clean, but they're clean a lot. And so, we can pull up charts or whatever. We'll pull up some live charts here in a little bit. But I just want to move through, and then I can pull up different markets based on request. So 3 filters for entries. So all 3, remember I said, we want 10 steps. The best way you can avoid a losing trade is to not get in. Okay? As funny as that sounds, it's like, well, obviously. But it's, you need to have some filters to help you avoid those losing trades. Okay? So it's not just, where you set your stops and tightening your stops and, risking, it's not just risk management. Part of risk management is just not taking certain trades. So I need 3 things to happen. I have what we call my Powerline Filter, okay, which is the confirmed trend. So if I went back on that, that's that green line. So if it's green, that means I will only take buys. Okay, it doesn't mean buy, but it means I have to have all 3 of these things. So I will only take a buy if I have a green power line. So the most recent power line, okay? Then I have to have what I call the Bar Breakout Filter. This confirms that momentum. So remember I said like I have the E, but then it has to break a few ticks above the high of the E before I get out. And we have settings for each market actually listed on our site. But I have that E-bar breakout. So if there's a green power line, then there's an E. Did it at least exceed it by 3 ticks? So for instance, up here, we got an E, but notice it did not exceed it by 3 ticks. So we did not get an entry here at the high, and we were able to actually go short from there and avoid that losing trade if we would have just hopped in on the E-bar. And then we got the barely missed X filter. And what that means is that happens, like right here, where basically got an A, P, E, and then it doesn't make the X because it doesn't break the high of the A, then I won't get in. So I'll show you some examples of those in more detail. But that's a quick summary on the first 3 steps of what I do in trading and what I'll be doing this year. So the Powerline Filter. Again, only trade in the direction of the power line. If it's green, I'm only going to take a buy trade. Okay? If it's red, I'm only going to take a sell trade, no matter what. Okay, that's my rule on my standard Apex entries. Now we do have a scalp trade system that we teach you. We also have a reversal trading system that we teach you that goes in with it. But if my standard just trend trading Apex. So if you're a reversing trade, if you like doing contrarian trading, we have a system built in that. BMX is a great contrarian trade system. If you're a scalp trader, there's modifications. But as far as it's really simple. It's just in and out on the E's there. But if you're looking for catching some of those medium-term trends throughout each day, then this is what you're going to want to do. Okay, so here's an example, of gold. We saw that one already. Right here, like if this would be in the background, you wouldn't necessarily see this. But what's happening is like you got A, P, E, so you would not take a short trade yet until you got the short power line. Now that I got the short power line, now that it's completed, so I have to wait. This is a key. I have to wait till I get that power line. So I would see this apex and I'd see this power line, and on the next apex I would take my entry. Okay? So it's always the second apex where I would take my entry. So I would not take the first one. And that also helps us avoid chop, because what if you get like a red apex and then a green apex and then a red apex and then a green apex? By waiting on that second one, it really helps you avoid a lot of chop in the market. Maybe you're a stock trader. Here's an example on Apple. So we got red power lines, breaks 3 ticks below the low of the E. And no BMX happening. Again, we'll talk about BMXs here in a second, but it's moving on down. This one right here, this actually would have been a BMX, so it would have avoided out that trade. And then we got an entry there, another entry. So you could literally keep adding on all day long, and then going long right here. So plenty of opportunities, no matter what market that you're trading. It's how markets work. It's how market movers move markets. E-bar breakout filter. The standard rule is 3 ticks. So 3 ticks or 3 cents or 3 pips, whichever you're trading, whether you're trading Forex or futures or stock. It's the same word. So if you don't know what ticks and pips mean, if you're a stock trader, what cents means, it means the minimum increment move. So a future trader will refer to ticks. That means 3 minimum increment moves. A stock trader will refer to cents, meaning 3 cents, like a 1 cent, 1 penny is a minimum move. And a Forex trader will refer to pips being a minimum increment move. So it has to break the high of the E by 3 ticks if you're going long within 2 bars of the E bar. In other words, if we don't get some momentum, we're not taking it. Okay? Or it has to break the low of the bar by 3 ticks within 2 bars of the E bar, or we're not going to take the short trade. Okay? Now, if you're using larger bars, you're going to be using like 30 and 40 and 50 size tick bars because you want to trade longer time frames, you may decide to use a larger E-bar breakout filter. So you could test that. But this is more for most of the traders are day traders. We do have some longer term traders. And but if you need help on that and you're longer term, you want to know, let me know. I'd be glad to help you out. Now, again, that's the standard rule. Like on a little more volatile markets, like on gold and oil, we use 4 ticks. We don't use 3. And just because we found that this, due to the volatility in those markets, they move so fast, so easy. They're also not as liquid. It's easier for them to move 3 and then turn around. So 4 has worked out a lot better. So an example, right here we got A, and then we got this E right here. Okay, notice there it did not break this bar right here. Okay, did not break 3 ticks below this E. So there was no short entry. Got another E, did not break 3 ticks. We got another E, did not break 3 ticks. Got another E, did break 3 ticks, and we took the entry. And what's funny is some people go, why didn't you just go long? Well, you just tell me how you would have known to go long. You got to have a rule. So what are my rules? And I'm going to take shorts when red power line, okay, and I have an E and it breaks 3 ticks below the E, then I'll take a short. So I don't catch every little oscillation, but as long as I can catch some decent oscillations, I can be happy with that. And I mean, right there, that trade was 5 points. So on gold, I mean, that's not bad at all. It's $500 on a single trade. We got another one over here that still going. So pretty simple rules. And I will tell you, it takes a little bit to learn, but it's not hard. It's not rocket science. It's not calculus. You just got to memorize the rules a little bit. But we have the videos that walk you through it step by step. Over here, I mean, check out how many bad trades the simple E-bar breakout filter helped us with. So we got an E, it didn't break 3 ticks. Another E, it broke 2, but not 3. Got another E, didn't break 3. Another E, didn't break 3. So all of that we avoided. Okay, now this is the S&P, and this is when we were, for that while, I don't know if y'all remember back, but we were, pushing the highs over and over and over again, and just kept oscillating. It was really weird because usually we'll have multiple trades in a day, and so we didn't get a single trade like on that day. The next day we still didn't get a trade until the end of the day. So unless you're going in like after hours, you wouldn't have got in on this one. But then it took off and we caught the entire move, and we didn't deal with this mess. I mean, look at all this chop. We completely avoided. Our money was not at risk. Our heart was not beating, and then we got to get the actual move. So and then it just did this little normal trend thing all the way up. So just by using simple entry filter, and one trade we got the move versus over and over and over again trying to be smart and outsmart the markets. Okay, barely missed X filter. So this is the third filter that we have. On the barely missed X filter, then what we're going to do, if a bar comes within 3 ticks or half the bar size, so basically let's just stick to 3 ticks to make it easy for now, of the high of the A bar, meaning like a market's moving up, and then, but it gets within 3 ticks, but it doesn't break the high of the A, then it barely missed making the X. Because how do you make an X? You make an X when you break the high of the A. If that happens, and I'll show you a chart to help explain it again, then we don't have any more entries until there's another X. Or until the entry pulls back and the entry price is actually below the last power line. So a short would be the same thing. If the market's moving down and it gets down within 3 ticks of the low of the A, but it doesn't break the A within like the next 2 bars, okay, then It's considered a barely missed X because it got close to making an X by breaking the low of the A on the short, but it didn't break it, so it barely missed making the X. And that is often what leads to a reversal trade. We get some great contrarian trades just off BMXs. And, here's an example. I have a euro-dollar chart up, and I'll zoom in. Like right here, it gets really close, okay? But it doesn't break. So we didn't get the 3-tick break on the E, okay, on that long there. And it got with just a few ticks of break in the high, but it did not do it to make the X. And then we have a BMX. And what's cool is this is sort of a more advanced trade. But what that ends up being is a short trade where we get in right here, and then we'd be looking to get stopped out about right there. So it'd be basically a very quick short contrarian trade. 2 hours, grabbing some decent pips right there. And then the market continued to go short, so we got another short. And then there's an E, but it didn't break 3 ticks below the E, so therefore we're not short yet. And currently the market's short on euro dollar with the signal. Okay. There are some different options we can go into. I don't want to overwhelm you with information, okay? But one of the things is, if you get in after a BMX, so when the entry price is under the power line, or the entry price is above the power line, if the trade loses, you probably don't want to take another entry. So what I mean by that is, let's see if I can find the best place to find BMX is on oil. I'll pull up a chart here and I'll show you. But basically saying, if you go in and you take a BMX trade, you're going to want to probably, if you how do I put that? Sorry. All right, so let's say we have a BMX. The only way I can get in is if there's another X, or if the entry is below the power line. So here's the green power line right here. So let's say I do get an entry like right down here. Okay? If that trade loses, I don't want to take another trade until I get an X. So I won't take an entry above the power line if there's a BMX. I will take an entry below the power line if there's a BMX. But if that trade loses, I'm not going to just keep stacking on one after another after another. All right, so this is an example of just a normal BMX, and on this one, it got in here, it went up, and it didn't break that high to make that X, so therefore we're done, we're out of the trade. If we're in it, we're out. We don't take that entry, we don't take that entry, we don't take that entry. We actually, in this case, don't even take this entry because, again, it didn't break 3 ticks above the high of the E within 2 bars. And so we avoided all those losses where we would have lost just by filtering some of our entries. And sometimes we get so caught up in trying to find the perfect entry that we don't go back and go, what are some good filters? And notice my filters, you don't see a whole bunch of lines on my chart, where I'm trying to go, oh, when this crosses this and this crosses that and this stochastic is overbought. No, none of that. It's all price action based. All right. So the one line you see on my chart, there is one little green red line. Doesn't really matter. Just something I've had on there forever, so I use it. But it's the orange line, and that's an 8-period moving average and exponential moving average. I just use that for my trailing stop. So whenever I'm moving my stop, I'll move it 5 ticks below the low of that 8-period moving average. It just gives me a little bit of distance. So it's not really a signal so much as just give me a little bit of room every time I tighten my stop up, so that way the market really has to move against me before I get kicked out. So I talked about position size. You need to know your position size, right? And I know you probably have not fully just comprehended and mastered everything I just said. Maybe some of y'all have. Don't feel intimidated if you haven't, because we have the step-by-step laid out for you over on the website, okay? So I'm just trying to, again, introduce you to the concepts here. If you're doing a trade, and let's say your entry price is 102, your stop loss is 100. I'm just using stock to make a really easy example, okay? So you buy at 102, your stop loss is at 100. The difference between the two is $2. That's the smallest amount you can risk per unit, so say per share of trade. And like I said, we have plenty of Forex and futures traders also. The percent. So what you want to do is, what's your percent that you'll risk per day? This is the formula I use and I teach people to use. and it'll help you survive, because one of the number one rules in surviving in 2014 is going to be just good risk management. So the percent of day max risk divided by 6 would be the dollar amount per trade. So if I have a $5,000 account and I can risk 5% a day, that's $250 a day. If I divide 250 by 6, that's $41 a trade. Now, that dollar risk per trade divided by dollar risk per unit, okay, equals the size of the trade. So basically what that means, in summary, is if I can risk $41 a trade and I have $2 of risk per share, I could do 20 shares. And some people get like, oh man, that's just not going to be enough. I can't trade enough. I don't have a big enough account. I don't do this. I don't care if you have a $500 account. I can show you how to trade futures. Okay? No problem. Forex, same thing. You don't need a big account to trade futures in Forex. There are ways to trade futures in Forex. Legitimate ways to trade futures in Forex with very, very small account sizes. So, big or small account size. But what's most important is not how big or small your account is how you manage your risk. And if you can get in there and you can start making a few percent a day, it adds up. But if you end up like risking 10% of your account, you're going to be wiped out, and you're going to be one of the 90%ers that don't make it 9 months. And that's because they risk too much money. And so I teach my traders, like, hey, where do you want to be in 12 months? Do you want to be here trading? Do you want to be trying to search for that next system and saving up money again because you lost it all? Where do you want to be in 12 months? And if you want your account to be ideally much larger, then go in and manage your risk and let it grow. It will grow much faster than you think it will if you'll manage your risk and you have decent probability. It will shrink much faster than you think it will if you don't manage your risk properly. All right, so that lets you know like what size to use. Now on the stop losses, remember I said I have 7 trailing stops, and again this is a sort of a water hose of information. So again, I hope you stay with me here. But I'm going to show you how to get access to the training, step-by-steps, the indicators, the live trade room, everything for free for a month with no credit card or anything, okay? It's very simple. We just put it 5 ticks, cents, pips, whatever, below the P-bar. If it hits that price, we get out. That's our stop loss. So I know what my risk is, and think about this. My bars are all the same size, right? Like they're all 6 ticks or 5 ticks or 10 ticks or whatever. They're all the same size, so my risk is the same on every trade. It makes it really easy to manage your position size. And the thing is, don't hesitate or think twice about it. Get out. There's going to be another trade. It's a lot easier to make back that money than it is to make back 5 times that money because you held on to it. Cut your losses short. Focus your energy on letting your profits run. And one of the things I tell people is think about it. If you don't, then what you're doing is you're cutting your profits short. And you're letting someone else's profits run against you. So really what's happening is you're actually letting your losses run against you, which means somebody else's profits are running against you. You don't want somebody making that money. If you're taking that drawdown, it's getting bigger and bigger, someone else is enjoying the other side of that trade. All right, so what are the 7 trailing stop exits? We talked about 1. We have that stop loss, okay? But we had the early exit, which is the barely missed exit. That's the BMX. So if we get a BMX, and if we did get triggered into a trade, like over here, if I got triggered in on this euro dollar, I mean, this didn't trigger, but if I would have, and I would have got a BMX, I would have got out of the trade quickly. Okay? So there's no reason for me to stay in that trade. I expect the market to go the other direction when that happens. I'm actually would be looking to take a short trade. So what happened was originally that BMX reversal trade was just a trailing stop, and I'm like, well, if I expect the market to go down, and that's why I'm getting out of my long, then maybe I should look at going short. And then, wow, lo and behold, there it was. Massive moves in the other direction. Great reversal contrarian trades. Every time there's a P bar, okay, I'll trail my stop again. Every time there's an E bar, I'll trail my stop. X bar, I'll trail my stop again. So over and over and over, I'll be trailing my stops on each one of these. Here's oil. Oil has BMXs like all the time. Okay, I mean it's a great contrarian one. And here's an example of a BMX on oil. Right here we had an A, we got the E, you got triggered, it came down. See how it got like right to the A, but it didn't break it? So within 3 ticks of the low of the A, but didn't break it? Well, that would mean 2 things. So if I went in and I sold like right over here, and then I bought back, so it goes there within a couple bars, so small loss, 5 ticks or so, 5-10 ticks. But I also would buy because I expect the market to go up from this point And then when I got another trade triggered, then I would get out of the trade. So I got another short, now I get out. And so I made, like, 15, 20 ticks on that. Not a big deal. I lost 5 or 10. I made about 15, 20. I'm up a little bit, but I went with that BMX. And then, other examples, we'll see just on the same chart. I'll pull some other ones up. But I get in, I got a PE, there's an X. Remember, so anytime you get a new X, you trail your stop. So that's an example. Also, when we get these velocity bars, these yellow bars that fire off, very often the market will reverse off of them. And notice, like right here, we get these velocities, they'll fire off. And so I'll show you some examples of that. And then we have a trade runner where if it's moving really fast, really far, which has to do with that expectation of movement, where we start tightening stops, then we'll tighten them up. So on the BMX, just like I showed you, got a BMX, I'm going to tighten my stop up, I got in this trade, and get out of the trade right there. So BMX, 2 bars later, exit the trade. I'm out. The X one. So I'm gonna forward through some of these. Let's see here. So the X one, every time that X happens, I want to trail my stop. So APEX, new high made, trail my stop. Trail my stop. Trail my stop. Again, not profits, but the chart's telling me when to trail it. When I'm long, when the trailing stop trigger event happens, I'm going to put it 5 ticks below. So let's say it hits the X, or we get a new P bar, or a velocity bar. Any of these 7 trailing stop triggers, if any of them happens, okay, I want to move my stop to 5 ticks below the low of that bar, or 5 ticks below the low of the AEMA, whichever's lower, if I'm going long. So this tells me exactly at what price to move my stop. And we've just found this to be a very good, consistent place to place a trailing stop. And so if I'm short, I'd do the opposite. I'd put it 5 ticks above the high of the bar that the trailing stop trigger happened, like where the velocity bar happened. And, for instance, here's an example. Okay, so right here I went, this is, live oil chart, where I go, let's say if I go short over here, okay, and on this short contract right here, then I end up tightening it up at the X, so I have a stop, I put 5 ticks above the high of the X, but then we get a velocity bar that happens. So I'm going to put 5 ticks above either the high of that bar or 5 ticks above the high of the ADMA. And then we get another velocity bar, so I'm going to move it down again to either 5 ticks above the high of the bar or the ADMA, whichever's higher. And then we get another velocity bar, so I'm going to move it down to 5 ticks above the high of that bar or the ADMA, whichever is higher. Because I'm trying to give it a little room to breathe. Okay? So I'd be looking for, velocity bars are awesome, because what a velocity bar is it's actually saying the market moved really far, really fast with no volume. You'll find there'll be like no volume in those bars. And the market's trying to fill orders. It's trying to grab orders. If it can't find them, it will reverse. Okay? If it can find them, it will continue. But it won't stay flat on a velocity bar. So it's a great trailing stop, because either that's telling you this bar is going to just keep flying, or it's going to fly the other direction. One of the two things is going to happen. And due to that fact, I need to tighten my stop, because I win either way. If it keeps going, great, I don't care that I tighten my stop. I just protected more profits. If it reverses, I'm glad I did tighten my stop, because I protected my profits. So we're seeing, live oil right here. Now this is, remember we had that BMX. And so now we're going short. And so we're waiting on either another BMX or we're waiting on an X for the trade to go down right here. It's moving step by step by step. So if it gets down here and it breaks the low of this A, then I could have a short entry. Okay, so that's what I'm looking at right now. All right. Let's see here. Okay, so we got the where to trail at 5 ticks above the bar, below the bar, or the ADMA, whichever is higher or lower. So, and again, that's when the bar exceeds the high of the A, it'll make that X, or if it exceeds the low of the A bar, it'll make an X. And here's just an example of a chart for you, just a historical chart for you. I'm trying to show you a little bit of historical to make it easy, but some live ones so you can see some real trades going on. So we got an E bar, we got an X bar, we tighten the stop. Okay, boom, that trade's out. We got an E bar, we got an X bar, tighten the stop. Another X bar, tighten the stop. Another X bar, tighten the stop. Another X bar, tighten the stop. So every time we hit an X, we tighten our stop. Okay? Very, very simple. You get a new P bar. Okay? Pivot bar, right? So new P bar, tighten the stop. 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 Still going. So it helps you maximize those profits. Same thing on the long side. New P, new P, new P. Okay, so we're tightening it on the P, on the X, on the P, on the X, on the P, on the X, all the way up. Tightening the bars. Also on the velocity bars. So I already talked about what a velocity bar was. So I got a little ahead of myself. But it's basically a bar that takes less than a second and has no volume, moves very fast. And so when those happen, then what we're going to do is we're going to tighten our stops up. So as an example here, we had a short trade. We saw this chart earlier on gold. We tightened up the X, we know that, but we also tightened on the velocity bar. So another trade over here, we got tightened on the X, but then we tightened again on the velocity bar. So it helps us capture some of those profits. Okay? And not necessarily capture, but protect. And so I like all the things I can have that help me protect my profits. All right, on Apple, we got velocity bars going off like crazy right here, just flying down. You don't care that you tightened it all the way, right? Because you're just protecting your profits in the process. It's going on. You got another velocity bar. You tighten your stop. It's flying. Over here, you got a long. You tighten your stop. So it's just moving really fast. In this case, this is 100 ticks. This is like $1 move. These are massive moves happening at once. Now, one of the other things I've talked about is how far the markets are going to move every day. Okay? So our expectation of movement in the market. And I call this is deviations. You may have heard of standard deviation. The problem with standard deviation is looking at past movement and expecting that to have something to do with future movement. But we've all heard the disclaimer 1,000 times. Past performance is not indicative of future performance. So therefore, it makes no sense to use standard deviation. What does make sense is to use implied deviation. I call these diagnostic deviation levels. And implied deviation is where I go in and I actually use the implied volatility. And this may be advanced if you don't know options, and you don't have to know all this. I'm just explaining what's behind the scenes. Okay? Implied volatility means expected movement. And implied volatility is built into an options price. So if they expect that the S&P is going to move up and down this week 20 points, they would basically have 10 points built into the call and 10 points built into the put, and there'd be a 20-point range in there, okay? And so then you'd have one standard deviation, or one implied deviation move would be 20 points on the S&P. Same thing. We're able to do that, but what I do is I extract out the implied volatility. Now I use multiple months options, 3 months options, and I weight the call and put side and do all their fun stuff, and then I actually calculate it out to 1 day. We're working on expanding this out to weeklies as well, but I already have it. I just got to automate it so that way it's not like manually sitting there trying to spend an hour updating the formula every night. But we actually automatically publish this every night at 8:15 because we have to wait on all the settlements to come in and all the implied volatility numbers to come in and everything. Once we get all that information, then what will happen is these levels will post for you right away. And you'll see them on there. And sort of an easy way to see them, I'll pull up just a time-based chart. Let's see here. And let's put it over on, where'd that go? I'll pull up oil for you. And we'll put this on, we'll just say, 15 minutes. Pull up oil. And then what I'll do is I'll put on 2 indicators on here. I'll put on deviation levels and deviation. And then it said OK. And now what it's going to do is it's actually going to auto plot the deviations for you right on the chart. And it's letting you know what's the expected move. The biggest help is actually this little orange indicator right here because it lets me know if from low to high did it move 1 deviation. Because notice how this sort of moved up to almost 0.5 and then down to negative 0.5. Okay? That is a deviation move. And watch how it bounces right off of it. And, here's another 1 deviation move right there. So it comes right down to that 1 deviation. Done. So this day, remember I said some days it keeps going. So we're going to tighten our stops. And if we're trailing our stops, we're going to enjoy this big 3 deviation move day. So it's pretty sweet. You can still enjoy it. And we actually use the deviations as one of our trailing stop methods that we use and that we teach you. And like this one right here, we just hit a 1 deviation move on a wheel today. Okay? So from low to high. So from high to low. So we went up, we came back down. So from high to low, we're actually at a deviation. So if you're over here right now on this oil trade that I had up, if we pull it back up, and we're sitting right now right at that deviation level. And we know that like we're basically sitting at a low to high deviation point, and now we're starting to see this. See how the thing that's like bouncing up and down right here? Well, I just bounced off a 1 deviation low to high. This 0.7 area, this is a low to high 1 deviation. So probably what I'm going to do, just to be intelligent, just tighten my stop, because there's only a 30% chance that oil is going to keep going lower. I didn't mind getting in it up here to ride it down, okay? But now that it's coming back down, it's hesitating. I'll just tighten my stop up. So that's one of the things that we teach you how to do. And now I don't have any risk on the trade. I protected some profits. There we go. And now it's going. And maybe it will break through that level again. This will be the third time it's hit this level, by the way. 1, 2, the third time today. We nail this level. So at this point, I may even go, you know what? I'm going to go ahead and tighten it again. There we go. We got our X. Sweet. So now I'm tightening on the X. Oh, and look what I got. I got a velocity bar. So right there, I got a velocity bar. So 5 ticks above the high of the low, the high of the bar, or the ADMA, whichever. So I got my stop up here. Just chilling out. Just step by step. X, move it. Velocity bar, move it. And that happened on the same bar at the same time. Either way, profitable trade. Okay? But yeah, there's just one example live trade for you. We have plenty of those, but every day. And we have room leaders that are doing the trades. They're actually showing the trades right in here. Let's see if Terry's on. Yeah, so it's Terry's got his trades in here going off and everything else. So he's actually posting stuff. Anyways, but there's a lot of examples where you can go in. But the deviations are huge because they let you know what's the expected move. And should you expect a whole lot more out of the market at this point? And if you don't know that, you're literally just going to be buying or selling right into highs and lows. So one of the methods I use is what's called the 10-minute deviation trigger. And it's I sort of discovered this by accident. I have a radio show I do every day, and I go through the markets and I go through the deviations, and I'm talking about them, and I'm like, okay, so we're looking at this market, we're looking at that market, and I look at 10-minute bars. It's a very standard bar just for scrolling through markets. A lot of professionals use it, so it's just a recap on the action, And I don't really use them so much for the live trading side. But what I noticed was on the 10-minute bars, and again, I'm not using my 10-minute bars for entries. I'm just talking about this is just a trailing stop method. And the problem is it didn't work on the diagnostic bars because they're so smooth. Is when a bar closed above a deviation line, if it came back and broke below that bar that closed above it, usually it like would completely reverse. I'd want to be out of the trade. If it closed below it, then it went back the other way, I'd probably want to be out of the trade. And for instance, let's try to pick one. On NASDAQ. Okay, so you get NASDAQ, you get a long signal, however you trade, whether you're trading Apex or whatever, you're going long. Where do you tighten your stops? Well, one of the simplest methods you can use is, let me throw this on here. There you go. So let's just say I go long, over here. Okay? And one of the simplest methods I can use is when it closes above. So that bar doesn't close above. I'll zoom in even a little more, make it easier. But this bar right here does close above this deviation level. So I move it to 5 ticks below that. And then I'm waiting for a bar that doesn't close above, doesn't, closes at, but not above, closes above. Okay, so now I move that to 5 ticks below the low of that bar. Comes back, hits it, I'm out, done. Okay, and by the way, we're at a deviation level. This is a +1 deviation. This is really what we expect on the day. And look, it ended right there at 1 deviation. So that's my trade. And very, very effective method for helping you, not just try to push it too far. And then short, you're doing the same thing. So here's a little bit more, just a historical example, but that was a live example. But right over here, closing above the bar, 10-minute deviation bar, got it 5 ticks, below that. And then what I also do, if it closes below it, after closing above it without stopping me out, so I moved it, but then it came down and closed below it, again, without hitting my stop loss, and then closed above it again, well, now I can move my stop loss even tighter. And then it closes above another one, I can move it tighter. And it closes above another one, I can move it tighter. So, and then finally it hits my stop, and then on this trade, I was definitely glad I did it, because then gold actually fell 20 points pretty fast. So it went over here, and then all of a sudden it just dropped. And so I was very glad I had tightened my stop. So short, we're going to do the exact same thing, just reverse. So we're going short. You get a short trade right down here. Then when the bar closes below the deviation level, tighten the stop. It closes above it without stopping me out, so I haven't hit that stop yet. And it closes above it again, below it again, I move my stop. Closes above it, and then below it again, move my stop. Closes below the next level, I move my stop. It hits it, and then the market just went into oscillation for like literally the rest of the day. So I was glad I was out. There was no money to be made. It was just chop, 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 chop. And that's usually what I see on deviations when they get hit, when the stop gets hit, is they'll go sidewards or they'll go up. So that's one of the steps I do in my trading that I'll be using, here in 2014. And then what I'll do is, so I'll have like this 10-minute deviation chart up in the corner with my main chart. So you can do like an always on top, but like a little mini chart, okay? So just sort of shrink it up and right-click always on top if you're using NinjaTrader. And I love using NinjaTrader. It's actually the only program we build this in. And you can go in, 3 ticks above the high of the E, boom, it's moving, moving, moving all the way up. And so putting it all together, entry, 3 ticks above the high of the E, hits the X, I trail my stop. Got a new P, trail my stop. Got a new X, trail my stop. Velocity spike, trail my stop. Velocity spike, trail my stop. New P, trail my stop. New X, trail my stop. New P, trail my stop. New X, trail my stop. 10-minute close above the deviation, like right over here. Trail my stop. New P, trail my stop. New X, trail my stop. Velocity spike, trail my stop. And then it comes back and it knocks me out of the trade. So that's like putting all the pieces together. But it's not as hard as it seems like, because once you're in, you got, is it green? 3 ticks above the high of the E. Is there a BMX? Yes or no? Okay. Yes. Awesome. I'm in. I don't worry about a P bar until I see a P bar. I don't worry about an X bar until I see an X bar. I don't worry about a velocity bar until I see a velocity bar. Okay. I don't worry about 10-minute deviation until I actually see on this chart it closes above a deviation. If I see it going above a deviation here, then I'll look over. So I don't have to even think about the rule until I see a velocity or P or an X popping up. And then we have the trade runner trigger. The trade runner is sometimes the market just takes off, right? And it moves half a deviation without you even moving your trailing stop. Okay, I mean, the thing just flies. And so you're trying to figure out, this is one of the good things because you're up a whole lot of money, but it's a bad thing because you haven't had a velocity bar, you haven't had a P or an X. The thing's just been moving steadily the entire time, and you're just freaking out because you're up a ton of money, but you've done nothing to protect it. And so part of that psychology factor we added in is, if I don't have a rule and this is happening, I'm probably going to give away a lot of money just because I'm flipping out that I'm up so much, and I'm just going to take my profit. And at least I'm making money. I don't care. I'm making money. I don't care. I'm just going to get out. And maybe the market moves another 20 points. Maybe it's a 100-point move on gold. But you're up 30 points and you haven't got a trailing stop. What do you do? So what it is basically is if the market moves half a deviation since the last time you updated your stop loss, then go ahead and trail it to 5 ticks above the most recent high after it moves that far. Okay? Because if it pulls back, you're going to get another apex. So if it actually does hit your stop, another apex is going to appear on the chart to allow you to get in again. So you don't care. So by doing that half deviation move, it gives me that what happens if the market takes off, it's working, it's going great for me, but I'm afraid I'm just going to take profit. So I want to avoid just taking profit just because of my P&L. So I'm going to use something absent of my P&L. I'm going to use the objective method of, okay, if it's moved half a deviation, that's a pretty big move, especially for no trailing stop to happen. So I'm just going to go ahead and tighten my stop at this point. If it pulls back, I'll get in again. We have another thing that we teach. It's called the 6 bar to break even rule. It's basically when you have a little bitty apex, So if you only had like 4 bars in an apex, like you had an A, a P, an E, and an X, or 3 bars APEX, like all in the same, like within 3 bars. If you tighten your stop on the X, I mean, sometimes nothing has happened. So if it's really small, okay, and I'll show you an example right here. Let's see how it's like APEX. If I tighten my stop right away, I'm probably going to get kicked out. So what I've done is when I get small apexes where there's less than 1, 2, 3, there's 3 bars between APEX. Then what I do is I basically let there be 6 bars before I move my stop to break even. So we got like an entry here, we got an entry here, we got an entry here, and what I did is I go, okay, now 1, 2, 3, 4, 5, 6. There's 6 bars. Now I'm going to move all 3 of these stops to break even on my trade. And then I get a velocity bar a little bit later, and I can tighten it up even more and lock in some profit. But basically, this is one of those rules. So what do I do if I'm moving my stop, but I'm moving it too tight because the apex is so small? So we built in little rules for pretty much most circumstances that we could, we run into. And this isn't just me. This is other traders in Apex, and we've worked together watching these charts for hours, days, months, years. And, have learned how to refine this strategy, over the time, and you get to benefit from that. So as a summary, you want to remove time from the equation. You want to use a simple pattern that is very system-based. You want to filter your entries, such as I showed you, like the 3 entry filters, and you want to trail your stops. When I showed you the 7 trailing stops. One of the special offers right now is what we're doing is we're giving you the Apex Elite membership, okay, with the toolkit for you can install it on Ninja. You get access to the Elite Trade Room, where you can hop in our live trade room and you can ask questions. And it's really, all traders are doing the same thing. It's not a follow the guru, because we're all using the same rules. So it's not like you have to follow me because you're never going to be able to do it on your own. You can, all you got to do is learn the 10 steps and do it. So it's basically everybody's in there sharing, talking, asking questions, and there'll be 1 to 5 traders will actually be posting their charts live in the room, so you can watch them mark their charts up. We have some other stuff that you can also get access to, hundreds of hours of education, so all that's included. And then NT8 is going to be coming out shortly. When that comes out, that version will be included as well. So, and you'll get the diagnostic bars, the sizer for the bars, the timer, the range, the scanner, the hot entry analyzer, the velocity bars. On down the list. There's a lot. The deviation levels. So what we're doing is we're actually giving you a 2-week trial, 2 of them. So not just 1, but 2 2-week trials for free. No credit card at all. And just on that, what you want to do is if you'll post that link in there for me. Yeah, there you go. So if you'll go to that link, and let me show you what would happen over here. So if you go to the link, and I'll pull up a browser, so you can sort of walk through the steps. And we go to ApexInvesting.com/ninja. Okay, that'll all forward you right to the free sign-up link. Okay, as soon as you're there, then you'll want to fill that form out and log in. All right, once you log in, so that link has it built in, so you'll get two free week trials, is right here where it says Apex Elite Member, okay? Click Free Trial. So for me, it will say you can't have one because I've already had it. But for you, it'll let you have it, and then after your 2-week trial is expired, it'll let you activate another 2-week trial. So the reason we're doing this, so that way if you get into it, but then like something comes up and you need a few days off, and then you want to come back and use your other 2 weeks, you can. So we're going to have 2 2-week free trials with full access, like uninhibited, everything. And what will happen is you'll be able to go up here, you'll be able to click on this link, and you'll be able to log right into the trade room and see the live trade room immediately. You'll also be able to go down here, and we have the training videos. So this is like sort of getting started, how to set up NinjaTrader, how to install the indicators, how to get your data feed set up. If you don't have a data feed, if you don't have a broker, where do you go? So the ones that we've worked with. And then this has the link for downloading. This is going to be important for you. So maybe you're already all set up. You have Ninja set up. You have your data feed set up. Right here is where you install the toolkit. Okay? So just use that step 2 right there on how to do that. If you need data, then we have links for you on all the different data trials that, are free ones that you can get access to. And then these are the rules. So these are going to be like step by step rules, and that we actually build them into a form style for you. So the reason we do that is so that way you can post questions on each step. So you go down here and you're like, okay, so I want to understand this whole Powerline Filter, and I have a question on it. You can go to that, you can watch the video right there, and then you can post any questions that you have on it. So that one's pretty basic. We don't get a lot of questions on it, but maybe you have a question on BMXs. Okay, so then we'll have a bunch of questions posted down here. I'll give examples, and so people will post different comments and everything. But just a place for you to ask questions there. Now you can also ask them live in the live trade room, but maybe nobody's answering your question because they're trading. Hop in the forum and ask. If you ever have a help desk tech support issue, just go to questions help desk, and right there, submit a ticket. We'll be glad to help you out. Okay, it's a trading question. We try to ask people to post them in the forum so that way everybody learns. But if it's tech support related, whatever, personal, private, whatever, just submit it in the help desk. You'll come directly to me, and I'll be able to help you out. But doesn't cost you anything. You don't have to put in a credit card, and you can try it out for an entire month for free. Learn, take advantage of it, and hopefully we'll be able to help you out and help you have a good trading year here in 2014. That's pretty much all I got. Are you there, Justin?